Okay, welcome everybody to today's webinar, Commencing and Ceasing a Pension in a Self-Managed Super Fund. Look, it's a subject matter that I feel like I've been talking about for, well, probably 20 years, but the reality is I have been talking about it for that long, and we've been through a number of changes through that time frame with regards to the rules around commencing and ceasing pensions. And we got to a point where in 2013 we had the tax office release a ruling, which is ultimately what the premise of today's webinar is that we had this ruling released, which provided us with a lot of information around the whole commencement process, but also then the cessation requirements. And then as a result of the introduction of transfer balance caps and other things in 2017, the tax office looked to update the ruling, and in doing so they provided a final version of the ruling this year and a draft one previously. And in the final ruling we pretty much got caught out in the sense that there were a number of issues that were raised within that final ruling that are quite different to how we've all kind of imagined things administratively, and more to the point, how we've processed things. So it's a real sort of turnaround in regards to the way we need to look at certain things when people, primarily when people fail to pay their minimum or meet their minimum pension obligations. So today's session, we're going to look at what constitutes a pension. Now that is again a significant thing that we need to be mindful of. Nothing new here necessarily, but a good time to sort of act as a reminder there when that pension commences, and sort of work through some of the documentation requirements there. Other commencement considerations that we need to work through, the 5 events that will cease a pension. What we then will focus on primarily after that is, as I said, the main one that's been sort of triggered by this ruling update, which is the minimum obligation, or more to the point, the pension standard. So I'll work through that concept and what that actually means. And then I want to finish off with, I've tagged it there as ceasing non-standard pensions. What I want to do is just really briefly run through the regulations that have recently been released in draft format by Treasury in regards to legacy pensions. So those that you might have where they're market-linked pensions, lifetime pensions, fixed-term pensions, but predominantly these days the one we see the most is probably the market-linked pension, and what opportunities might exist with regards to ceasing these types of pensions in the future. And it's a kind of a fingers crossed approach, and we will see how we go with those styles of pensions. So as always, if you've got any questions, please put them in the Q&A box, but let's kick things off and talk through our requirements with regards to what constitutes a pension and when a pension commences. So the key thing, I guess, the key thing is what we need to understand is what dictates where or what a pension is. And the first thing that we need to look at there is the SIS Act. So what are our requirements under the SIS Act with regards to meeting the pension standards? So we go to SIS Regulation 106, and then that breaks it down. We previously had 106.1, which of course still exists, but in the account-based pension environment that we all now operate, that was what came about from 2007. So we've got all of our pre-existing pensions, so our legacy pensions, as we like to call them, sitting in sections or subsections 106, 1 or 2 through to 8, right? So 2 being lifetime, 4 being allocated pensions, 6 being flexi pensions, 7 being fixed term pensions, and then 8 being market linked pensions. And then we've got our 106.9 pensions or 9A pensions, which are our account-based pensions. And so what we need to do is we need to make sure that all of our pensions now meet the conditions of SIS Regulation 106.9A, and that is firstly that the payments are made at least annually, right? That payments excluding commutations, now this has been sort of an area that has chopped and changed over the last 15 years, but payments excluding commutations are in accordance with Schedule 7, which is our minimum factor, and you can see the Schedule 7 numbers there to the right of the screen. That the pension is transferable to another person only on death, and of course that is also quite specific as who that can be paid to. primarily the spouse, but there are a couple of other exceptions, but let's say largely the spouse in that regard. And then the capital value nor the income can be used as security for borrowing. So these are our principles that we have to operate under to ensure that we have a pension. And then what we need to do is we need to work through the ruling and the concept to determine what the ATO determine a pension looks like, to ensure that we get ultimately the key outcome. And the key outcome of paying a pension is ultimately the exempt pension income deduction. So when we're looking at the capacity to access money in the form of a retirement income stream, then really what we're looking at there is the ability to withdraw money and get the associated tax benefits with it, right? So what we have to do is we have to work through the concept. And as I said, I'm going to talk through a couple of things around commencement with regards to the advice piece and all those sorts of things as far as from a consideration point of view. But let's assume we've gone through that and we've made the decision that it's appropriate to set up a pension for a client. So then we need to know, okay, well, when is that pension going to commence? And that commencement, it must be referenced. And again, I'm going to make a lot of references to TR 2013-5. Must be determined by reference to the terms and conditions of the super income stream agreed by the trustee and member, the rules of the superannuation income stream as set out in the governing rules. So what we need to ensure that we have is the capacity within the trustee to pay a pension. Let's say that every deed is going to satisfy that requirement. But then how much more a deed says is going to be often tailored to the deed provider. Will the deed require the payment of a pension in accordance with the terms of a pension contract? And in that case, then what does a pension contract look like? Do the deeds stipulate all of the requirements for how pensions are to be paid? That to me is a fairly uncommon approach. Like, you'll generally see more the capacity to pay a pension in accordance with the law and the rules governing the pension. And of course, the problem with a deed that says that you can pay a pension in accordance with the law is I pretty much just read you the law. And the law is that, you've got to make a minimum payment, you've got to pay it annually, and it can only revert or can only go to certain people on death. So, as far as how all the conditions of that work, you're left ultimately to your own device, which is why the deed and any subsequent governing rules are going to be important to determine the conditions associated with the pension that you're trying to start. So yeah, looking to ensure that you're satisfying all those requirements is fairly important with regards to pension. And the advent of pension contracts over the last sort of 10 to 15 years, pretty significant. Someone that's been around as long as I have will remember that a lot of pension commencements were effectively set out on one page. Previously you'd see a minute to say that here's a pension, here's the terms, and this is what the trustees agree to do. But again, if you try to break that down, and I'm not suggesting that those documents don't stand up now, but if challenged from a perspective of other actions that you're trying to take other than paying payments in accordance with the minimum, etc., then does the pension, or will the pension stand up to any potential challenges for actions that might be taken? And again, most of those sorts of things are going to come around when we're talking about the death of a member. So just having an appreciation that ultimately the old way of doing things is really long gone, and we need to provide more substance to what we're producing with regards to pension commencements. And that can be problematic if you're relying, I guess, in certain extent to the pension documents that can be churned out by the various software providers. They do a good job at what their primary purpose is, and that is to reconcile the fund to prepare financial statements. The fact that they also have documentation to support a lot of the transactions is good, but how significant or how substantial those documents is certainly something that would need to be reviewed, because some will pass all the requirements they need, but others, and I suspect that pension commencement documents are one of them, probably don't have enough information held within them. So some of the key things, or two of the key things that we need to look at with regards to the commencement of an income stream is, one, what the tax office determined from a definition point of view, what a superannuation income stream is. And so to pull out the extract from the ruling, it is a series of periodical benefit payments that relate to each other over an identifiable period of time. I'm going to come back and look at that in a moment. In addition to that, what the ruling requires primarily is that that there is a member's request that is received before the first pension payment is made. So we need to, I guess, identify and recognise, how we acknowledge pension commencements. Okay, so are we talking about pensions with, say, a 1 July start date? Is there a pension that's starting during the year? How do we go about that process? I've put the word there, the dirty word in the superannuation industry, backdate. Well, that's a word that has been I guess what's the word I'm looking for here? It's a word that we don't want to associate with the way that we administer superannuation funds, but it's a word that it always springs to mind when we say, well, okay, I started this pension on the 1st of July, and it's now November, so we have to backdate the documents. Well, ultimately what you are needing to do, if it's taken from July until November, to get the numbers to work out what the pension minimums are as such, then you still need to get the application in place before the 1st of July. So the member must apply to commence a pension on the 1st of July, and then the documentation that you implement in November is reflecting further to the request to commence a pension on the 1st of July that was received by the member. Here are the final numbers to be able to do the work. So it's really almost a two-stage process when you're looking at pension commencements in the self-managed super funds, to ensure that you've got that acknowledgement piece prior to the start date that you want the pension to commence, and then you've got the supporting documentation which is going to finalise all of the necessary information, primarily from a transfer balance cap point of view, with regards to ongoing reporting obligations. So there's some of the key things, and we've got sample documents that people can see in regards to that area. But I want to touch on that concept of a series of periodic payments, because where we have in those regulations that I addressed before, we have one clear issue there. It talks about that pension payments can be made annually, right? And so then you go to that definition and it says a series of payments that can be linked together. So we've got this scenario that arises where you have pensions that can start on the 1st of June in a financial year. And if we've got the pension starting on or after the 1st of June, then there is no requirement to pay a minimum pension in that year. Doesn't mean the pension doesn't exist. It means that the ECPI ultimately kicks in on that start date. So let's say the 1st of June, right? And no payment is required, no problems at that point in time. You've then got the next year. So in this case, the 2025 year, where we've got the minimum pension obligation, right? And that obligation being paid between the 1st of July and the 30th of June, right? If it's paid as a single lump sum, right, it could or would at that point in time be considered to be a pension payment. And all of our earnings are assumed to be exempt current pension income, and all those benefits are non-assessable, non-exempt income. So that's how we're operating in the stock standard scheme of things. But then the client says they want to commute that pension on the 30th of June 2025. And they say 30 June 2025 because they don't want to commute it on the 1st of July 2025 and commit to a one-day pro rata pension requirement there, which of course in hindsight, in what I'm about to explain, would be actually beneficial. But they take this approach to say, well, we want to do a full commutation as at that date. What we would need to know now is this fund in retirement phase, and is it in fact paying a pension? Because if we go back to the ruling, it states that a liability to make a single payment each year for a number of years can constitute a liability to pay a member a series of payment, i.e. to meet that definition of an income stream. However, the ruling goes on further to say a single payment in 1 year doesn't constitute an income stream. So if we take this situation where someone starts a pension before the end of the previous financial year, doesn't pay a minimum because they're not required, then pays one payment in the next year, and then stops that pension, that's not a pension. And if that's not a pension, then all of that ECPI is non-existent. So the fund is going to be assessable as an accumulation-based fund. And the benefits, look, again, assuming that this person is over 60 years of age and has met a condition of release, then those benefits will come out as a lump sum, but it's ultimately going to not satisfy the definition of a pension and be just lump sum withdrawal. So in this instance, what we're needing to suggest, or what I would be suggesting is, one, annual payments serve a purpose, but they're risky, and people should always try to have multiple payments, even if they're irregular payments, and document that they're going to draw irregular payments, but will at least take the pension annually. If they do that, then it's not a problem. Two, the 1 June start date, whilst there's no minimum requirement means that you don't have to meet the pro rata amount, but you can draw an amount, right? So you can draw a small portion there. But realistically, what we're saying is you've got to be making sure that that payment is paid and physically paid over 2 years to ensure that you've got a pension in place. So just to round out those commencement considerations that I was highlighting before, said, is it okay to simply backdate the pension documents from a commencement point of view? Well, it really comes down to, again, the information that is stipulated and provided within that tax office ruling that says that the commencement day cannot occur prior to the day established as a commencement date in the terms and conditions agreed between the member and the trustees that will govern the superannuation income stream. So again, the terms and conditions, the pension documentation, is going to be critical to determine whether or not a pension has commenced. So, arguably, the idea that a pension is backdated doesn't exist and shouldn't exist. What you are doing, as I said before, is putting in place the process or the confirmation of the numbers supporting the income stream that has previously been requested via application of the member. Go down that path, and then you're going to satisfy your requirements from a timing point of view. The other thing to take into consideration, and so whilst I highlight the concept from a single pension payment point of view, and to say that you're going to make your payments annually, but there might be more than one payment, so annually is the go-to for the trustee, but they've got the capacity to take frequent or additional other payments out, and those payments be treated as pension. A lot of that's going to come down to how we document our payment discretion inside of the fund. And again, a lot of this is material that from a tax office point of view, it's been in place since 2013, but we've kind of always taken a fairly flexible approach to it. But in the post-transfer balance cap environment that we now operate in, what we're seeing is the ATO scrutinising transactions far greater, in my opinion, than they ever have before. And so if the ATO are scrutinising these things, then we as SMSF professionals need to make sure that we're also scrutinising and ensuring that trustees understand what needs to occur. And all you have to do is read through the multitude of supporting material that the tax office publish in regards to these pensions to ensure that you're doing the right thing. And so when we are setting pensions up, and when we are nominating minimum payments and payment frequency, we have to make sure that what we're trying to do is provide enough flexibility within our arrangement to say, okay, well, the obligation or the trustees will be obliged to ensure that each pension meets its minimum, and so that all payments will be allocated to ensure that all pensions meet their minimum on an annual basis, and then have instructions for our members to suggest or to make suggestions of how any amounts in excess of the minimum are to be treated. So whether those amounts in excess of the minimum obligations will be utilised to be treated as lump sums from the accumulation, or to be paid as additional pension payments from account-based pension number 1 or number 2 or whatever it might be, or to be applied proportionately across all existing pensions. So there's no right or wrong with regards to it once you've met the minimum. But things such as the tax-free taxable components, estate planning considerations, all of that's going to come into consideration as to how pension payments are going to be allocated. But what the tax office have made clear in their communication is if you've got two pensions in place and you've got $5,000 that you have documented is coming out of pension one, I'm using 5,000 as an example. So you've got $60,000 coming out of pension one, and you've got $2,000 coming out of pension two. So you're paying 60 from one pension and 24 from the other. But the minimum for pension one is 40,000 and the minimum for pension two is 30,000. Well, in your mind, you're going, well, I've paid out $84,000, so I've covered that $70,000 minimum. The tax office is saying, no, that you are saying 50,000 is going to pension one and only 24,000 is going to pension two. So you have a $6,000 shortfall of pension two. And then based on their ruling, that pension will cease, right? So what you would be better off doing is identifying that each pension would be paid in full from any payments that are made out of the fund, and then amounts will be allocated firstly to account-based pension number one, and then any excess to number two or whatever it might be. So it's really important to, if you're going to stipulate numbers, to stipulate enough, right? Or to avoid stipulating numbers and creating problems for the funds. So other things that we need to consider, and some of these are our long-held conversation pieces with regards to pensions, and most of you, if you've listened to me speak before, you know that I love to argue about pros and cons of reversionary pensions, and certainly 100 arguments either one, probably not 100 arguments, but enough arguments either way for reversionary versus non-reversionary. But again, the best time to sort this out and to set this up is when a pension is commenced. So to identify who reversionary pensions are, because you may, subject to the terms of your pension set out in the governing rules, and the governing rules are more likely to be the pension contract than the trust deed, right? You can change the terms of the pension midstream, but the tax office have highlighted before that only if the rules say so. So otherwise, you would have to do a full commutation and cease and recommence that pension to ensure that it meets the new requirements that you want to do. So again, the concept of reversionary versus non-reversionary really is a pre-planning piece. From a strategy point of view, you need to make strategic decisions around things like the income allocations, things like the reversionary pension, but also whether the fund's investment strategy has contemplated all of the necessary requirements to ensure that the fund has the liquidity to meet its minimum pension obligation, right? Because there's one thing to fail to pay the minimum because of a mistake due to banking or something else. It's another thing to not have the liquidity to pay that pension, because to not have the liquidity means in the very small circumstances where you can rectify a shortfall, right? If you haven't got the liquidity at 30 June, then you may not have the liquidity in July either, and you're just exacerbating the issue and creating more issues for the fund. So you need to make sure that you don't go down that path. And then asset segregation, again, segregation, which we spoke about segregation, I think in our last webinar. The segregation is a prospective transaction. So whether or not you wish to segregate assets for both taxation, but also member reasoning, the election from a segregation as to the choice for ECPI and actuarial certificates, that is a post event, but the ability to segregate assets and to create separate investment pools is a prospective transaction that needs to occur, or preferably occurs before the start of the pension or the start of the new financial year. So we need to understand from a commencing point of view, what are our trust deed rules, what are our preservation and condition of release, because we might be able to commence a tris, for example, which is going to still retain preserved benefits, and it's going to put a restriction on what we can do with regards to our withdrawal limits versus an account-based pension. Obviously, the other strategy elements too, and revalue the asset. Then from a commencement point of view, we need to lock in our purchase price so we can do our transfer balance cap reporting. We need to lock in our new superannuation interest so we can separate and calculate our tax-free and taxable components from a proportioning point of view, firm up the reversionary nature of assets, do our segregation and all of our other necessary documentation. So they're all the key things that we need to contemplate when commencing a pension, which obviously leads us then to, once we've commenced, under what circumstances is that pension going to cease? And this is where the tax office have updated their ruling and updated it to the point where even the draft update that they provided didn't cover off on the position that we've actually landed on. And so we ended up with two different views from the ATO. And I'm going to work through those two views so you have an appreciation for what you may have thought you were doing okay versus what is now no longer okay from a SIS point of view. So the ruling does outline that a pension will cease for income tax purposes when the funds are exhausted. Easy, right? So when you've got no more money, there's no more pension in existence there. When the pension is fully commuted, and of course to fully commute the pension, we also then have standards that we have to satisfy within the SIS regulations, and you'll note on the right-hand side there that the SIS reg is Reg 107D, which talks about our requirements to ensure that we've had a pro rata payment made prior to that commutation at that point in time. The pension will cease by operation of the payment standards, so such things as when we have a child account-based pension, so that pension might be paid up until the child turns 25, and it must cease then unless they are a disabled child and they can continue to receive it under that. But without that disability, the pension must cease at 25, and that is dictated by the SIS Act again and confirmed by the tax office there. The death of the member, where there is no automatic entitlement to a reversionary pension. So that whole concept of reversionary versus non-reversionary really then comes down to, okay, well, when a member dies, then that pension stops if it's not reversionary. Now, the pension stopping and the ECPI deduction stopping are two different things with regards to a non-reversionary pension. And we know that the ECPI, there is provisions written to allow the exempt current pension income deduction to continue on until the death benefit is paid. So the obligation to pay the pension stops on the date of death, but the exempt current pension income deduction continues until the death benefit is paid, and then the death benefit is paid in the proportion of the commencement of the pension from a tax-free taxable position, with the exemption, and again, we did this earlier in one of our webinars, with the exemption of insurance proceeds, which if it's a non-reversionary, then those insurance proceeds would take on a taxable component. And then the main one that is now creating all of the key issues. So when this ruling was first released back in 2013, it was that whole death benefit issue that created the problems from an industry point with regards to when a pension commences and ceases. It is now pensions that fail to comply with the pension rules that will create the biggest issue and angst for self-managed super fund trustees. Now I appreciate, having done admin for so many years, that there are reasonable number of funds that fail to meet the minimum pension payment in a year. This ruling has the scope of requiring all of those pensions to have to go through a physical commutation and recommencement of the pension. So we know the failure of the compliance of the pension standards means that we haven't made that pension payment at least annually. We haven't met the minimum, or it's transferred to somebody other than the spouse, or it's been used for security and borrowing. So if we take out those final two as the key issues, right, we ultimately come down to that one key point, which is the minimum pension. So if we fail to pay the minimum pension, then we create a problem. Now, the tax office, where they originally landed with this, was that we had a situation where you'd have I'm just putting everything up on the screen there, so that the pension rules are being met, and then in the previous year, like on the 1st of July, we would start the year, minimum of 60,000, only paid 48,000. We look at the ATO's general powers of administration to see whether there's any discretion there. There's no self-assessment discretion because it's more than 1/12, and I'm going to go through that discretion in a moment. So you would have to apply to the commissioner for their discretion to say that the pension doesn't cease. But from a transactional point of view, what happened was the pension would cease on the 1st of July for tax purposes. The pension would cease on the 30th of June for T-bar purposes, because you can't fail the minimum pension standards until the 30th of June. And so therefore the T-bar debit is the 30th of June. What the tax office previously said was that the new pension, like subject to you then meeting the minimum pension in the next year, that the new pension would automatically start again for tax purposes on the 1st of July 2024 in that set of circumstances. So that's where we've been based on the draft ruling from the ATO. Then the ATO released their final version of this ruling. And in this final version, right, it goes through the concept that says a superannuation income stream, I'm not going to read it all out, but is taken to have ceased income tax purposes if any of the requirements of the regs relating to the payment of the super income stream are not met in the financial year. This is the case even if a member remains entitled to receive a pension from the fund. And it then goes on about not having to be paying a super income stream at any time during the year, and then it cannot recommence meeting the SIS requirements in a future year. Right? And the fund must cease, for example, by commutation, and a new super income stream must commence. So this is the key thing, is that we cannot meet the requirements in the future year, and we would need to make a decision, actively make a decision to commute that existing pension and start a new one to be entitled to receive the exempt current pension income. And so what it came back to was, and people sort of wondered why the ATO made this position clear. And one of the things was they referenced a number of their other online materials, and they got feedback to the draft ruling where they'd made this previous position, and they were actually challenged by a number of parties to say, well, you're not actually applying the rules in this circumstance as you have in other circumstances. And I reference this case, and the ATO in their ruling reference this case, the Commissioner versus Douglas, and it talks about the idea that it states that the standards must be met, right, when the fund ensures all of the conditions are met. And so to say that you have a minimum obligation, but then not ensure that those payments are made, means that you can never meet those standards again. And so what it's ultimately done is basically said it's turned on this one word, right? And the ATO have then taken that and applied it across, looking at all circumstances, using this case as a reference. And they said, okay, well, that's got to be, we've used this reference, we've used this Douglas before, and that is in regards to that annual pension. So them determining what an annual pension was before, they'd gone back and referred to the Douglas case. And so they've effectively used this to say, actually, our position has changed, and it doesn't matter what you have from a trust law point of view or from a SIS law point of view, that pension can never ensure that the annual minimum payment has been met because it's failed in 1 year. So therefore, it can never be a pension for the purposes of the tax exemption. And so what it now means is that if we look at that same scenario of 60,000 minimum where we've only paid 48,000 for the year, well, we've got our pension ceasing now for both tax and SIS purposes on the 1st of July. So the pension's actually ceasing on the 1st of July. There's not going to be any ECPI for the income year, and the new pension will not start automatically on the 1st of July. And let's be clear about this. Most people won't know that they're going to fail their minimum will not know that they have failed their minimum until some point after 1 July. Because if you know at 1 July, well, then you're going to do everything to make sure that that payment is made on the 30th of June, right? So often the failure of the minimum is not going to apply to a later date. So in this instance, let's say March 2025, right, is when we find out that the minimum pension has been failed for that year. It means that the exempt current pension income will not apply from the 1st of July 2023 right through to the 1st of March 2025. And in fact, at that point in time, we are required to consciously make this decision to commute that pension and start a new one. And so we would be starting that pension on the 1st of March and then doing a pro rata of that pension from the 1st of March through to the 30th of June. And then we would get our exempt current pension income deduction. So it's pretty significant change from the ATO that is going to result in I think, a significant number of funds. Right? And when I say significant number, I mean, we're probably talking thousands. We're not talking hundreds of thousands, but we're still talking about thousands of funds. And it's a nuisance measure. It's a nuisance issue. I mean, this ruling it's a troubled ruling now. It was a pretty reasonable ruling before. It's a troubled ruling now because it's also saying ultimately that most of these pensions failed years ago if they didn't pay the minimum. But of course, they're not going to go back and look at these issues. But it causes so many other issues because we've now got this shortfall that hasn't met. So let's address that piece before identifying some of the other key issues. Because if we fail to pay that minimum, do we have an out clause? And what we do have is, with the Commissioner's powers of administration, they do have the capacity to say that the pension conditions were met and the exempt current pension income did exist, and so therefore not have to go through this process. But what we know about those conditions is, for you to be able to self-assess, right, for you to be able to make that decision yourself, then the shortfall must be less than 1/12 of the annual minimum, right? And the fund must be a first-time offender. So it must be the first year that there is a failure of that minimum pension. And then you have that 1/12 element. In all other circumstances, right, you cannot self-assess. Right? So if you fail the minimum, you've missed 1 month, and that 1 month just happens to be less than 1/12, which hopefully, if you've done your calculation, 1 month is, and you make that payment up in July, and clearly then have to make another payment to get the next year on track. One time only, you can make that assessment there. Other than that, you have to apply for discretion from the Commissioner. Right? Now, I've seen that discretion apply once. Right? I know some others that I've spoken to have seen that discretion apply once or twice, or that discretion be granted. But in most sets of circumstances, right, if it's an error and you're the trustee of a self-managed superannuation fund, and you knew you had that obligation and you haven't paid it, then most circumstances are not going to result in the Commissioner providing that discretion. Now, if I jump back to this slide here, if you apply for that discretion in March and don't take that decision to consciously commute the existing pension, and start a new one, then how long is that ECPI removal going to last for? So the problem with going down the process of applying for discretion from the Commissioner is that's not going to happen straight away. And so that might extend the loss of ECPI, and by extending that loss of ECPI, it's going to create other issues. One of those issues is going to be valuations. So what is the new valuation? Because what does the new valuation mean from a new reporting of the pension? So we've got here a decision to require to commute. We've already got the T-bar transaction from the 30th of June. The failure transaction needs to be reported. So ultimately, we need to be reviewing these funds certainly at the first quarter of the year, because we need to report that failure as a debit, right? And then the reporting of that failure creates just one issue there, and we'll look at the T-bar in a moment. But is that pension a separate superannuation interest? Should we be rolling that in and should we be rolling it in at the 1st of June or July 2023, or at the 1st of July 2024? because then it's going to have ramifications on the tax-free and taxable components. Now, of course, right now, the general administration process is that remains as a separate interest, right? So it remains a separate interest. You don't get that ECPI, but people aren't winding that back and putting it into accumulation because they haven't had to. So what we need from the ATO is further information. So, well, do we have to actually roll that back into accumulation, or are we just treating lump sums or treating withdrawals as lump sums from that amount? And if we are not rolling it back to accumulation, then are we applying the tax-free and taxable proportions that would normally apply to a pension interest? And this is why it's a bit of a dog's breakfast from from an update point of view, because it's now creating all these further administrative issues that there's now uncertainty on from a mainstream administrative point of view. So it's significant in the problems that it's creating for the fund. But take it beyond things like the tax-free and taxable portions, take it beyond the transfer balance account reporting, take it beyond the ECPI. It also has issues from a social security point of view. So from a grandfathered pension commenced before 2015, you're going to have potential issues from a asset test exemption from a Commonwealth Seniors Health Card point of view. You're going to have issues with the pension ceasing and going from deductible amounts to deeming amounts and things. So there's all sorts of other considerations with that pension ceasing as a result of this ruling and the final position. So we know that, and then, I've just made a comment there about death benefits, so I'm going to touch on death benefits in a moment. But when do we get the finality? When do we get a position from the ATO on all of these other matters to help us administratively move forward with minimum pension shortfalls? And I know the Self-Managed Super Fund, the SMSF Association, have certainly been engaging with the tax office about a number of these issues because they're regularly in communication with them. So to look at it from things such as the T-bar. So if we have the account-based pension there of 1.7 million at 30 June 2024, the pension fails, so we'd get a debit for 1.86, which would be 8876, which would be the value as at the 30th of June. But then we commence a new pension. Now, the thing is, under the concept of the previous ATO view, that debit for the failing the minimum and the credit for the new commencement, because the tax office had said that a new commencement a new pension commenced on the 1st of July, pretty much crossed each other out. Now we're moving to March 2025. So maybe we're in a situation, and a lot of trustees would hope they're in a situation where the value had gone up in the fund from July to March, which means that we're not going to actually be able to put all of the money back in. And if we automatically do put all the money back in, are we going to create an excess transfer balance account situation for our clients? And so we just need to ensure that that we're on top of all of the key issues with regards to that as well. And so, without dwelling on it, what I will just say is that I know what we've undertaken is some changes to our rules within the fund deed about pension rollbacks and the like. So it's important that people do take the necessary steps. But let's look at two other key issues, because I think it's important to address them, and that is failing the death benefit pension requirements. So if we've got a reversionary pension, and remember that this is why one of my arguments for non-reversionary versus reversionary pensions. A non-reversionary pension, there's no minimum pension obligation. So death trumps everything. There's no requirement to pay a pro rata minimum for that year. Right? Reversionary pension, it's a continuation of the existing contract. So the pension's calculated at the 1st of July. The pension must be paid, the minimum must be paid by the 30th of June the following year. Right? If that reversion, let's say that the member that passed away was the one that does all the transacting in the fund and regularly pays the pension, and the spouse doesn't participate so much, maybe not necessarily a great practice, but let's be honest, that happens inside of our industry probably quite significantly. If that minimum pension isn't paid from a reversionary pension point of view, then what we would have to do is we would have to say, okay, well, can we apply the general powers of administration, and can we apply the 112 shortfall? Does that exist there, or do we need to apply for discretion? If not, then do we look at the option of purchasing, so cease that pension as quickly as can, and purchasing another death benefit income stream? So effectively taking the fact that we've met a condition of release being death, the member met the condition being death, they've met their cashing requirements because they paid a pension, right? We then know that unlike an account-based pension, that money cannot roll back to accumulation, right? So if it can't roll back to accumulation, then objectively the money has to be taken out of the superannuation system. But the ATO previously provided some guidance on this to say, well, okay, if you immediately start a new death benefit income stream based on the age of the reversionary pensioner, et cetera, right, then we would say there's nothing to see here. You'd lose the ECPI up until that point in time, but you could commence that next pension. The tax office have removed that reference from their website. So we have to hope that that is still their approach to death benefits. And to me, it's still the most practical approach to take, is to start a new pension with the proceeds. Again, that's going to have some potential transfer balance cap ramifications, given you've already got the 12-month reporting credit occurring. Now you're going to have a new pension, and so you then have to do some form of commutation of the reversionary pension, which is going to make the transfer balance account look weird up until the point in time that the credit appears on the account, or you just ultimately would number three there, take that money out of the superannuation system. So we need to be careful there. And of course, TRIS is an even bigger problem, right? So if we fail to pay a minimum under TRIS, but more importantly, or not more importantly, equally as importantly, is if we pay more than the maximum with TRIS, then it's not about ECPI anymore. Now it becomes about the payment standards, and we have accessed preserved benefits, right? And so by accessing preserved benefits, right, we're in breach of those preserved standards. So is that money going to be taxed at our marginal tax rate? Are we going to have other compliance issues, or will the commissioner apply their discretion to treat these payments as pension withdrawals? And so, you know, the scope of this goes far broader, and we know that that the ATO had previously released some material on this under the guise of a tax determination for industry as such, or for individuals, and a PSLA, which is more in practice, how would the ATO treat it internally with regards to discretion in reference to overpayment of pensions or illegal early release of money. Now, the issue with these documents is that they were withdrawn from the market, for want of a better term, and the ATO said that they will get back round to it, but you know, they had other priorities. Now, maybe one of those priorities was the completion of TR 2013-5, right? And maybe we're going to see some activity with regards to these documents, because I think it's important that we understand and have a good appreciation if somebody does the wrong thing as to what that's actually going to mean for clients moving forward. So yeah, there's a lot of key issues to take into consideration with reference to this failing the minimum pension. But I can't emphasize it enough that we're going to have to act, and you're going to have to try and act as soon as possible. So if you've got, I mean, firstly, the first consideration is obviously that you're doing regular pension reviews with your clients to ensure that they're paid the minimum pension prior to the 30th of June. And of course, having this material now available to us gives you that capacity to say, this is the ramifications of you not doing that, right? And that the ramifications are that the amounts will be treated as a lump sum. That's not going to mean neither here nor there to the individual who's in account-based pension over 60. They don't care if it's a lump sum or a pension, right? Because it's all non-assessable, non-exempt income. Right? They are going to lose their ECPI. So have they done any significant transactions from a CGT point of view that are going to be impacted by it? Have they done any significant estate planning, which means that they have created separate interests to ensure that they can leave certain money, taxable money over here, tax-free money over there? Have they gone through all those processes, and will the failure of that minimum unwind all of that? And then there's the nuisance thing from a timing point of view, from a reporting point of view. How much are we going to people going to charge to do this additional work? So there's all sorts of problems linked to it. So I can't reiterate enough that people look to try and get these matters resolved sort of at their earliest convenience. So then the other thing that I wanted to finish off with today, because it's all linked in my mind to the idea of when does a pension commence and when does a pension cease. And it's interesting because that ruling, TR 2013-5, only applies to account-based pensions and transition to retirement income streams. All other pensions are governed by the SIS regulations, and the SIS regulations really don't say a lot. You know, they talk about, they have, here's your minimum pension obligations, or here's your range from a market link pension point of view. They tell you what your commutation obligations are, but they don't really go into the depth of what happens if you fail to pay the pension annually. And so you're seeing more and more of these scenarios arise. And yes, you're definitely going to lose the exempt current pension income, but in theory, there are ways to go, okay, well, perhaps now we can rectify it by, if it's market link pension, you stop that pension and start another market link pension. But one thing that that has sort of, I won't say it's taken us by surprise from an industry point of view, but it's certainly been a pleasant introduction from the government. It's not often we get to say that, but what we saw not all that long ago was that Treasury released a consultation. So they released some draft regulations which would allow individuals, right, to get rid of or to get out of certain legacy items. And those legacy items were lifetime pensions, fixed term pensions, and market link pensions. Now, the idea of this legacy pension cessation, and it was previously announced as a legacy pension amnesty, has been around for a number of years. It was announced by the former government, committed to by the current government, but we just hadn't seen anything. There was always an expectation that in light of the announcement of Division 296 that we might see something in this space. And it's fair to say that these regulations were introduced primarily because, well, not primarily, because of Div 296. So the government want to introduce these to be able to fix up matters around valuations and defined benefit pensions, and that prior to the introduction of Div 296. So I've been involved with the SMSF Association on the consultation with Treasury about these regulations, and I can tell you 100% that these regs are linked to Div 296. Of course, there was capacity to communicate with Treasury and to provide submissions, and I hope that all submissions sort of suggested, let's de-link these great regulations from any requirements to do with Div 296. But what are the requirements, and how are we going to benefit from them? Basically, for anyone that's been playing along, they'll know that those old pensions, particularly fixed term pensions and lifetime pensions, subsequently created reserves inside super funds. Market link pensions, slightly different. But what the government had previously announced was, if we look to get out of these with this amnesty, then there would be some form of tax arbitrage where you would have to wind them up, but you'd be slugged with some tax. These regulations are, if they come in as they're written, any existing pensioner with lifetime, fixed term, or market link pension can commute those pensions in full, including the value of reserves, and they can either start an account-based pension, it's going to be subject to the transfer balance cap, they can leave it in accumulation, or they can take it out of the superannuation system. No tax consequences, nothing. So they are looking at a total cleanup of these pensions if these regs come in. So if we've got failures, if we've got all those sorts of things, if we've got these clients that they're all getting old, right? These clients with these pensions are all in their mid to late 80s, if not older. They don't want these pensions. There's a caveat. Those that are getting 100% asset test exemption from Centrelink probably do want these pensions still, but then do their families want to have to deal with the reserves linked with the pensions? And so the regulations are addressing a lot of those key considerations. There's still a bit of work to be done, particularly around things like Centrelink. But ultimately, they are going to be a free opportunity to pull apart these pensions and not have to deal with them anymore. So from an exit point of view, from a cessation point of view, it's going to be really good if we see these regulations come into play. There's a side issue attached to this, and that is that these pensions largely have reserves linked to them, and some of them have created reserves because the member has passed away or whatever, or the pension has ceased. And so there's a secondary level of these regulations that are actually going to deal with reserves in self-managed super funds largely, and give us the opportunities to wipe them out a lot quicker than we currently have. So if the reserve is linked to an existing compliant pension, you'll be able to wipe it out completely. If it's not linked to an existing compliant pension, we'll move from an environment where you can currently allocate on a fair and reasonable basis up to 5% of the member's account balance without having any cap issues. And if you do it over and above that, then you're subject to the concessional contribution cap. This change is going to say we're scrapping the concessional cap and any link to the concessional cap, and we're going to make the link to the non-concessional cap. So all of a sudden, we're going to be in a capacity where we can look to make allocations to members up to potentially $360,000 from these reserves. So that is pretty significant for an ability to offset these reserves for those that still have them. There's one part that hasn't really been addressed by the regulations, or not to a great enough satisfaction, and that is when a member has passed away and these reserves are sitting there. So how do we allocate monies without having to engage in the non-concessional cap process? And we actually have approached Treasury about the idea of saying, if the member's passed away, can we look to just treat that reserve as part of that member's interest and pay a death benefit? Because we feel that there's a lot of people in the industry that would be much happier to pay the tax on a death benefit, which they would normally pay anyhow, rather than allocate money, deal with the self-managed super fund, deal with the winding up of the reserve that way, and potentially have to stay in the SMSF environment. So that's something that's being contemplated by Treasury there. But it's certainly good set of measures to be introduced, and I'm looking forward to the progression of them, particularly being a part of the process. So, having an understanding of what this is going to mean for your clients with regards to their total super balance, their transfer balance cap, and estate planning needs is certainly something that people take into consideration. So, to wind up today, to bring it to an end, there is clearly a focus from the tax office on the income tax laws. I mean, that is their bread and butter with regards to the payment of income streams, more so than the SIS Act. They of course are the regulator of self-managed super funds, so they're mindful of the SIS Act, but their focus is the tax act there, and that the failing to pay the minimum is clearly the biggest issue that we have to deal with. It is going to impact death benefits. It is going to impact transition to retirement income streams as well, and we need to understand what those ramifications are going to be. If you've got the ability to self-assess, then do self-assess, but you've only got that ability once. So be mindful of it. So, there's still plenty of opportunities from a pension point of view. And if people are doing everything right in pensions, then there's still great environment to be in with our ECPI, our ability to separate tax-free and taxable, and all those other things. But we've got to make sure that we get it right. And then finally, that these legacy pensions are certainly an area for the few that exist, and market-linked pensions are certainly more prominent than lifetime and fixed-term pensions. But the capacity for us to be able to get rid of them is certainly something that the industry will be pretty keen on. So my last comment will be, we obviously as an accredited educator or approved educator, I think it's accredited educator is the word, for the SMSF Association. We will be at the national conference, so they wanted us to make sure that we were also helping them promote the national conference. Their early bird is open, I think, till 5th or 6th of December. But by all means, if you want to go and engage in what is a really good technical program, then the SMSF conference is a great place to do it. So I've done my little bit of advertising there. Other than that, as always, you will get your CPD and certificate sent through from SuperGuardian. So I provide the details to them, and SuperGuardian will then pass that on to you. You'll then also have access to the recording if you need it. Thank you all very much for joining me today. I've enjoyed talking about this subject matter that I've spoken about a lot over time, and I suspect will continue to do so moving forward. I'm off on annual leave. I'm going trekking in the pool next week, so I hope to see you all at our December webinar where we will be talking through a year in review. So we'll touch on a lot of these issues because there's been some significant stuff with the gnarly changes, the intro, or the potential intro of Div 296, the legacy reserve stuff, the pension ruling, other rulings that aren't updated yet, and what they mean. So I'll try and bring that all together and summarize 2024 for you on the 10th of December. So I look forward to seeing you all then. So thanks for coming and have a great rest of the day.